Hello and welcome to the Investor Master Series. My name is James Boyd. We welcome all of you here today. We got in the chat, Truth Will Always Prevail, David, Daksha, John, Sharon, and many others. Good morning to you. Now, just real quick, as we talk about Investor Master Series, this is really taking stocks, it's taking fundamentals, it's taking technical analysis and options, that different education, trying to bring it all together. We might also introduce maybe an advanced option strategy here today. I'd like to do one example of that. So the purpose of this class is to bring all the other classes that you learn together outside ETFs and futures and really bring them together and use that education combined. Now, as we get started here today, remember that options carry a high level of risk, not suitable for all investors. Also understand the information here is provided for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. This webcast discusses technical analysis. Wednesday at 4 p.m. Eastern, we talk about fundamental analysis. So if you want to learn more about that, check that out tomorrow. And also remember, when we talk about investing involves risk, including loss of principal. Okay, so we're trying to get a balance there of risk and potential reward. Now, as we talk about examples, they are just that. We will be using a paper money thinkorswim account that we usually use anyway. So now in this class, we always try to talk about indexes and sectors to start off. I'll also mention a couple key other symbols that we want to keep an eye on to track market posture. Then what we're going to do is we're going to talk about a neutral example on the S&P 500 as we're coming up into the election, okay, and a multitude or a swath of earnings. And then what we're going to do is talk about some examples of what stocks are bucking the trend and also which examples might be showing maybe some risk of pulling back. Now, what I want to do here is I want to bring something up, and I want to start with just the good old SPX, okay? Now, one of the things that we talked about, so yesterday, now just quick FYI, I did about 15 minutes ago, the class from yesterday, Trading with Technical Indicators, was posted about 15 minutes ago. The class topic we talked about yesterday was on exiting, okay, targets, stop adjustments, and so on. If you haven't actually seen that class, make sure that you do, okay? So we always try to bring up material, education that could be timely and helpful, okay? Now, when you look at the SPX, kind of tell me what you see on this chart. Now, it's not important what I say, okay? It's important what you see, okay? So if we look at the SPX, what you're now going to notice is kind of, we want to see where's price in relationship to the moving averages, okay? So if we see that, we look at where's the price in relationship to the moving averages. We're below both. If we zoom in on this, now what you're going to notice is there's even a cross, okay? So if the SPX is a proxy, kind of for maybe what the average stock is doing, what's probably happening on many positions? They're going up? Probably wouldn't say that. If this is like most stocks have probably fallen down below the shorter term moving average, maybe even had a crossover. So stop adjustments, exiting, option protection, that would probably be a pretty good example of timely technical analysis, right? So on the SPX, kind of a little fall down. Now I want to do a trade on the SPX. If we look at the SPX, what you're going to notice is it massively bearish? I don't think we could say that. This is kind of pulling back for some recent highs. We could even say that, is there maybe an upward channel, something like this, okay? So do not take away from our conversation that, oh my gosh, a pullback means bearish. That's not true, okay? But we are kind of fading back some off the highs if we're just being brutally honest. Now, the NASDAQ, if we take a look at that just real quick, the positive here is the NASDAQ is staying very flat, not pulling back as much as the SPX. The one that it has pulled back, or I should say two, the Dow Jones looks like the S&P, okay? The cross happening currently and the price dropping down, okay? Again, if we kind of go back to where's the old breakout point, the old breakout point was right around 423 and change. I mean, is it unusual to check back to where you went up from? This could be this was the higher high. that might be the higher low. So kind of basic technical analysis we see is nothing unusual, but yes, fading back up the high. Strategies like covered calls, strategies like callers. If someone does a bearish strategy, a true bearish strategy, buying puts, long put verticals, short call verticals, those might be shorter term in nature because you don't have a bearish trend. You have a shorter term pullback on price. There's a difference, okay? That the one that's kind of being roughed up a little bit here today is Mr. Russell. And Mr. Russell, if you take a look at this, sitting here about 220, so excuse me, 22, 26 and change. We drew this line from yesterday. We said, hey, it's not unusual. We check back to the middle of the channel. This would be a negative if we cannot hold that 20, 22, 25-ish area. Because if you don't hold that, that means you could fall back down to 2184. Okay, so kind of, we're kind of at the point of our bull's going to come in here and help. Now, volatility. Can anyone actually tell us why is the VIX staying a little elevated? Why? We have Connie Hill in the chat. So if you have a question and you see a response, that's CH Connie Hill. Okay, the two redheads got you covered this morning. Now, if we take a look at this, what we're going to see is when we take a look at volatility, we got an election coming up in 2 weeks. I mean, that's out there, okay? That's not political. That's just what it is, okay? And if you take a look at, let's say, we got a whole bunch of earnings. And if investors are a little bit thinking, hey, we've had some nice moves, and I want to protect my positions, the investors thinking, they might be willing to pay a premium for that protection. They also might be thinking, hey, I think the market is going to be volatile. Now, how many of you in chat are thinking the market in the next 2-3 weeks might be a little bit more volatile? Anybody? Does anyone think that it might be a little harder for the market to maybe keep going up in the face of that? Anybody? Okay, now, so sometimes we know that we have markets that go up sideways and then down, or up a little, down a little. Wonder if you were going to be a little bit more neutral to the market. Well, I want to talk about kind of an example we don't normally do, but I want to talk about it here today. And that's going to be an iron condor. Two verticals, okay? Two short verticals. And we're going to kind of forecast. And when you do any trade, you're making a forecast. A forecast does not mean actual. It just means you're thinking, this is what I think the trend's going to do. Only time's going to tell us what actually happened. In the world of fundamental analysis, they call it ex ante forecasting, okay? A forecast return. Ex post would be it actually happened, okay? So it's a forecast. Now, if we take a look, I want to go to some others. So do we see any signs of real bearishness yet? So first thing I want to kind of point out is the 10-year yield has exploded higher, okay? That's been very interesting despite the Fed talking about lowering rates. Interesting. Now, the one thing I also want to point out is when you look at the dollar index, oh my gosh, okay? If you have, let's say, no pesos, but you have the U.S. dollar, that U.S. dollar relative to the other basket of currencies, well, the U.S. dollar's done quite well. And so now you're thinking about international vacations. So that U.S. dollar that went down has swung all the way back up. And this is probably a good thing why we introduced currencies the other day, as we talked about in the futures classes. Okay, so the dollar being very strong. And if that dollar is actually strong, okay, or when we see the 10-year interest rate go up okay, the dollar index go up, kind of interesting. Investors abroad might be chasing higher returns and deeper markets in terms of liquidity. Okay, now those products are tradable. 10Y is tradable. Okay, it's one way to do it. There's other ways to do it as well. Connie teaches that on Monday at 4 p.m. Eastern. And also, if you look at, let's say, the U.S. dollar compared to other currencies, that's taught at Thursday at 9:30 a.m. Eastern, okay, with futures. So keep an eye on those. Now, the one that I said, and I'm going to keep saying this, okay, if you're talking about is there real fear, well, if this chart is going down, we don't really see fear, real fear. Because if there was fear, this chart would normally be going up. Think of this chart as the international VIX. Okay, so if this chart is going down, technicians might be thinking it's probably more of a shorter term pullback than a true bearish market. Just keep an eye on that ticker. Now, when we look at, let's say, sectors briefly, energy, flat as can be. You look at staples, sitting there, okay? When you look at all these, for example, these sectors, I could not find a blasted one of them that looked bullish. Now, if you did, tell us what you saw. Now, technology's holding there. Okay, we might say that's more neutral, but it's neutral, okay? You look at healthcare, that's a fresh new short-term low. You look at utilities, kind of ascending triangle-ish. You look at discretionaries, okay, sideways. You look at even financials that had a huge move last week in that flag posture. Now, basic materials also getting pulled back on after making a short-term high. And you look at the industrials also getting pulled back on. So guys and gals, okay, don't say anything really bullish. Okay, yesterday we talked about moving up stops, targeting, right, exits. So what we're seeing on the indexes and sectors is kind of parallel to what we talked about yesterday. Now, that does not mean we're long-term bearish. It just means that, hey, short-term, we're having a shorter-term pullback so far. Now, are there any questions with that? Any questions? Now, the first trade example that we're going to look at, okay? So remember, when you make a trade or an investment, I don't care if you're buying an income stock, maybe like a Philip Morris, whatever it is, you're making a forecast. Else, why would you do the trade or investment? Okay? We're going to look at an example of SPX, okay? Now, I want to kind of build this. Let's say the investor makes a forecast of, James, I think the market is going to kind of be a little choppier. The investor thinks that maybe the market might not necessarily go straight up, might not go straight down, but they actually think that maybe the market might go more neutral. Now, let's build this step by step, okay? So, step one, we know what a short put vertical is. You sell a higher strike put and you buy the lower strike put. Receive a credit, has a built-in maximum loss. Now, the product that we're going to use is we're going to use the SPX, the cash index, okay? Now, it doesn't have to be that, but we can't do ETFs, so we're going to do the cash index. Now, what I'm going to do is I'm going to bring up, now here's the fun part, okay? Get ready. If we're going to go to the 20 December, the problem is if we went to, let's say, the November, that is barely, we're only talking about 23 days from now. And if there is some vacillation greater than expected, we want to kind of give a little bit more time for the volatility to play out, okay? Now, what I'm going to do is let's kind of go to the at the money strikes. Now, this is the good part. The fun part is there's lots of strikes, okay? Now, if we were to, let's say, choose on the put side, okay, we're going to look to sell a put where maybe we're going to go the lower end of the range we normally talk about, a delta of 30 to 40. Now, I want to kind of double check something, okay? So if we sell, let's say, the 5,700, where is that on the chart? Now, remember, whatever strike you sell, that's where you think the price could stay above. So if we look at the 5,700, it's right there, okay? And then whatever strike we buy below to create a maximum loss, it's just going to be below the strike that we sold, okay? Go back to the trade tab. So open interest, 55,000. Bid-ask spread, about 40 cents wide. Not bad considering how high the premium is. Now, if we go down and look at, let's say, the put side, if we were to do the 56.90, okay, you're going to see that it's right there. But if we want to kind of widen out just maybe a little bit more, okay, the 56.80, we could look at both those to kind of see if there's any difference. 40 cents on the bid-ask spread, and that one right there is about 40 cents, okay? So in this example, we're going to right-click on the 5,700 and then buy the 57.90. Now, this is step number one of an iron condor, okay? Now, I want you to also note that it says AM expiration, not PM, okay? Now, if we look at this, you're now going to see that the 5690, there it is, and then we get a credit there, okay? When we look at the numbers, you got $10 wide spread, you got 215 on the credit there, and if we look at the maximum loss, 785, okay? So if we look at those numbers, 215 divide by 785, it's about 27%. Some investors, okay, they might want at least 20, 25. It's a little bit more than that, 27.3. Just taking the maximum gain given the vertical, divided by the maximum loss given the vertical, okay? Now, what we're going to do is I also want us to notice there's a commission that we're used to, but if we trade the SPX, there is a fee there of $1.20, and that makes the credit less because of the commission and fee. Now, what we're going to do is we're going to look at the buying power effect, okay? Whatever that max loss is, that's the buying power, okay? Now, I'm going to bring this up so we can see this, okay? So if I analyze the trade, I want to kind of show this. So when you look at a classic vertical, okay, you're going to notice that the delta is very, very small. This is only for one contract. We'll adjust that in just a moment, okay? So now what you're going to notice, there's the strike that we're buying. There's the strike that we're selling. And now we see this dotted line. That's where the price is right now. And you're going to also see that if we look at these two lines, as I stretch that out, you're going to see the break even today and the break even expiration. Now, if we look at this and kind of say, what's the risk? Is the risk delta? Well, it's close to zero. Gamma, not really. Theta, okay, 0.24 negative. But probably the greatest risk of this, if volatility were to go up. But why is that so negative? Well, it's because you're selling a strike closer to the current index level, okay? The theta should be turning more positive as we come closer and closer to expiration, okay? So this trade is not about direction, else delta would be higher, okay? It's about theta, positive theta over time, okay? But the risk is volatility expanding, okay? Now, what we're going to do in this case is we're going to go sell, okay, the 5,700, buying the 5,790, and what we're going to do in this case is we're going to do 3 contracts. Now, let's go 2, because I think that's going to be kind of at the level that we could discuss. Now, position sizing is the part of this, okay? As an investor, you want to think also about protecting yourself, okay? So if this balance, and I'm not talking about portfolio performance, okay? I'm not talking about that. But if I look at this balance, it's at 254 and change, 254, 379, and we said, hey, we're willing to risk a potential for our example of a half of 1%, it's 12,071. So if we did 2 contracts, it's slightly more than that. Now, we could do that, as you'll see in just a moment. It's not dramatically higher. It's $300 more. So you have to ask yourself, is that okay or not okay? Okay? So what I'm going to do is let's add on this second piece. Okay? We're going to say first triggers execute. Make this order fill first, and then do the short call vertical. Okay? So what you're really trying to do is you're trying to really sell something. Sell a put where you think the price is going to stay above. Sell a call where you think the index level might not go above that. Okay? Now, if we were to take the same idea and sell something with a delta of 30 to 40, if we went in the lower end of the range, well, trying to be more conservative. Okay? A delta, remember, delta is the change in the approximate change in the option price given a $1 change in the stock price. Okay? You could also think about that as a proxy for the probability of being in the money at expiration, plus or minus 3%. Okay? The other way you could look at that is probability of ITM. Going to give you very close numbers, typically within 3% of each other. Okay? Now, what you're going to notice is I'm going to right-click on that 60/50. We will also visually look at this on the chart. Now, I'm going to tell you right now, Some of us, we're only bullish investors. I just think it's going to go up. I think it's going to go up. Well, sometimes you don't get the index to go up. Okay, you get the index to be neutral. Now, could you do a trade like this and try to still look for bullish positions? Yes, that's what we're going to do. But we're thinking in our example, in the pay money account, that, hey, wonder if the index just kind of goes more neutral. And let's say we take two of these. We're going to go to the chart, mark that 60-50. And if we go to this, we got 60-50. Okay? So if I look at this and say 60-50, right there. So what you're going to notice is it's kind of like parallel, okay? It's not tilted to one side or the other. In other words, if we look at kind of where we are now to here, or where we look at where we are now down to the bottom, it's pretty close, okay? If we kind of said how many points to the downside, it's about 140 points to the downside. If we look at the top side, it's about 160. Are you with me on that? So we're not skewing it one way or the other, okay? We're just kind of trying to do something where the price is in the middle between the strikes that we're selling. Now remember, what is this strategy called? If you do two short verticals, well, it's an iron condor. Now, if you look at this, you get a credit for, okay, the short put vertical, and you get a credit for the short call vertical. Each one of those sides has a maximum loss. Now, if we go to confirm and send, kind of take a look and see what it shows, we are in the IRA account. You're going to notice that if someone did two contracts, the buying power effect is 1570. It's not really taking a lot of capital to do this. And you're going to notice why. I see that we're back. Let me know. Yeah, I'm just watching. Okay. So thank you for the patience on that. So I saw it go off and I didn't move it. This is just explaining the order confirmation. Okay. Now notice when we combined a short put vertical and a short call vertical, it's not changing the max loss, because you can't have the price at expiration in two different price levels, two different index levels. Okay. So let's say at expiration, it's at 56.50. Well, you'd have a maximum loss on one side, but the call side would be maximum gain, and vice versa. Okay. Now, what you're now going to notice is if I bring this up, let's kind of put this together, and then we're going to talk about some directional trades. We're going to analyze this trade. Now, what you're now going to notice is it has really more of like a cowboy, we call it a cowboy hat, okay? And now what you're going to see is this is really showing more of a neutral range. 5,700, that's what we sold. And if you look at this, 60.50. So we're thinking that price is going to kind of stay in between here, okay? Now, if we start to go to the left or down, well, you start to have a portion of the maximum loss. If you close at expiration down below that short strike, well, I should say in the long strike, the 56.90, maximum gain on that side. But this side would have the maximum gain, and vice versa if the price level were above the short strikes. So really what you got to think is the maximum loss, if we close up here or we close over here, the maximum loss isn't really what it seems given only one vertical, because that means on one side you got the other gain from the other side. So it's not as big as what you would think, okay? So what's the goal of this strategy? Have the price level stay in between the short strikes and have time decay, okay? Hopefully evaporate. And we got to change that to two strikes. That's why it kind of looks a little unusual, and we'll do that. And if we did that, by the way, that's what's kind of nice. As you position size, and there's your classic cowboy hat, what made it different is we only had one strike on the put, two on the calls, and it looked a little different. When we look at this, what you're going to now notice is we're trying to get the time decay. The investor doesn't think the price is going to move really up or down. A neutral strategy is still a strategy. The risk of the trade, though, is volatility expanding, okay? And that's the risk whenever you're short an option, whether it's a call or a put. Now, we don't normally do this, okay? We're not neutral investors in the classes that I teach. I talk about trading the trend, trading technical indicators. We tend to actually talk about strategies that are more bullish and bearish. However, we're not blind to kind of earnings and also the election. And if the investor says, you know, James, I don't really think the index is going to move that much, I'm going to do an iron condor, which is 2 short verticals, and we're going to kind of forecast, and it's just a forecast. We'll have to see what happens with time. We're trying to really play this like we would a short put vertical. 50% in 10 days, 65% with 20 or more days, or 80% ever. Same idea there. Send the order. Now, what we're going to do is, if that fills, now on the iron condor, when you have multiple legs, multiple strikes, might be a little harder to fill, especially if we talk about it for a while. We will make sure that that fills, so we get what fills, okay? Check. The short put vertical fills, okay? So there it is, okay? The other side of this, the short call vertical fills, okay? So that does fill. Now that theta is showing in this case, if we take a look at this, what's the theta on that position? Theta on that position is about 592, okay? So for those 2 contracts, theta being about 6. And remember, as we go closer and closer to expiration, that theta is going to tend to get higher and higher. Now, this does not mean that you can't say, James, I see some positions that are bullish, but I'm thinking the index might be more neutral. This is just one position of many, okay, or of our examples. Now, the question is also, so here's the deal. Shive actually says, but the potential volatility increase to the election hurts this position. That's true because you're short the options. You're short the options that are close to the current index level. But you got to remember the volatility, they tend to price in the volatility and the earnings and the price prior to an event, okay? So if all of a sudden what investors think happens, whatever that is, okay, that volatility can tend to fall. And it's just like what you see with regular earnings on stock charts. Volatility will tend to ramp up to an earnings a couple days prior to earnings. The volatility tends to top out. Earnings, whether it's good or bad, comes out. Where does the volatility tend to go? Even if the price goes down, the volatility tends to drop, even if it's bad news and even if the price drops. So we're kind of thinking, hey, if that volatility kind of comes back down a little bit, could those short options get some help as we get past some of the earnings and that election? Now, I'm not really counting on that per se. I mean, I think that's a tough forecast. That's the idea. The idea is more on price neutrality, index neutrality, and also time decay. That's really what this trade is hanging its hat on, okay? Now, down here on this SPX, we're going to go ahead and put this in the vertical section, okay? Move to group, and I'm going to put that right in the short verticals, okay? Now, let's kind of talk about what are maybe some trades that might be bucking the index trend. Well, one of those stocks that, for example, has held up quite well, and let's kind of talk about volatility now, okay? Now, I like to think about volatility, okay, as anxiety. Okay? Now, you might not even know what that is. Some people, you're like, yeah, I can tell you what it is, okay? So we're going to bring up implied volatility, and let's apply this. Now, notice what's happening, okay? As we come up into this earnings, does the volatility wait until the last second to really go up? No, because investors can see when the earnings is. And as soon as they know when those earnings are, they start to have the volatility. It tends to go up. And notice the volatility has gone up despite the price going up. Okay? Now that's a little unusual. Normally, if the price goes up, the volatility goes down. When is that not the case? When there is typical earnings or a lot of news coming out about the company. Now, the example that we're going to show here is let's say you said, James, I want to be bullish Amazon. but I want to kind of be more protective. Okay. I'm not forecasting neutrality. I think there could be a slight upside potential gain, greater potential odds of the stock going up. Now, the kind of nice thing about Delta is when you look at different strategies, each has a different delta. Okay. And if we went to the trade tab, what we're going to show in this example is on the IRA. Now, why do you kind of say the IRA? Well, because we need to think about, as an investor, we want to kind of think about if we decide to do a cash secured put and we were assigned to buy the shares at the strike price, is there sufficient capital to buy the shares of the stock? Okay, so that would be a good thing to go through your mind ahead of time, okay? Not later. Now, what I'm going to do is, if we look at, let's say, where is the volatility? Well, on the November expiration, what you're going to notice is, ding, 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 the implied volatility is at 41. If the investor says, look, I'm going to go to the December, I think the implied volatility is going to fall, that implied volatility, which is annualized, okay, bad word, is 34%, okay? Now, if you look at that, if the investor says, James, I want to play volatility, where are they probably going to go? The November expiration or the December expiration? Which expiration could be, on a percentage basis, more hit by implied volatility dropping? The investor might say, James, November, okay? Now, what's the risk of November, okay? Well, risk of November, you have less time. If it takes an adverse price move the wrong direction, you have less time for it to actually bounce back, greater potential assignment risk, especially because you have less time, okay? And we're going to go to the November expiration, okay? Now, when we talk about examples, we normally talk about monthly options that have greater than 20 days to expiration. So it has 24. Okay, fine. Now, if the investor says, James, one of the kind of things that happens when the volatility goes up, so do the premiums. Okay? Now, why is that of interest? Well, the potential gain is higher, but it also makes it where the break even is lower. Okay? So the chances of being above break even is higher. Okay? Now, if we take a look at this, let's kind of use Delta as kind of a range that we're going to look at. If we said, James, I want to really sell maybe like the 180, okay? Remember, this one has 24 days left. And what I am going to show in this example is only selling the short put by itself. What is the risk of if you just sell the 180? Well, the risk of selling, okay, the 180 by itself, and I want to show you this. If we went to option theoreticals and Greeks, went down to Theo price, and if we pull this up, just kind of change that right there, option theoreticals and Greeks, and then go to Theo price. Now, here's kind of something that blew my mind at first. Let's say that Amazon, the price didn't go anywhere. But the one thing you'd probably say is pretty probable, okay, is that volatility might go down. Now, this right here is not volume. That's volatility. Now, if that volatility actually dropped just 5% on an option we already sold, well, if today was the earnings, and let's say the volatility dropped by 5%, now we're past earnings, sold it for about $375, and now the option becomes worth less. Okay? Now, why is that? Well, if you suck air out of the balloon is not as big, that balloon being the premium. And if that volatility drops 10%, some of you might say, hallelujah, okay? And if the volatility drops 10%, if you sell it for $370, that could become worth, theoretically, $217. So if you're selling a put by itself over earnings, yeah, you got greater price risk. This is looking at an annualized amount, and that's looking at a dollar amount. They're thinking it could go up 16, but don't just read what you want to read, but also show that it could go down 16. Hello, okay? So what we're going to do in this case is, now, by the way, what's a double gain? A double gain is if the stock went up and volatility were to go down. That would be a double win. The way it would be a loss, most likely over earnings, is that, for example, the stock goes down and the volatility offsets, keyword is some. Okay, so the way you lose in this trade is the stock goes down. Okay, now in this case, we're going to sell the 180. Okay, and what I'm going to do, normally we would show that we're buying a put below, and we could do that, but I'm trying to just get all theta decay. Okay, and if you sell this, number one, you're putting up more capital. The risk is all the way down to zero. Okay, that's the risk. Okay, and we can see that on confirm and send. You're going to notice it's going to ask us, they call this a cash secured put. If the investor does this, they're really saying, I am comfortable with being the buyer at 180. Now, that's usually what everyone says before the stock drops. Okay, but it's a real risk. Okay, they're saying the max loss is 17,000 because if the stock went all the way to zero, okay, whatever that is, it's also the buying power effect. Note the commission. Credit. Now, if the investor said, I want to buy a put just in case, it's up to them. We're going to go ahead and send that order. And by the way, so notice what that does. It eats up quite a bit of capital. So the investor might say, well, I got tons of cash, but you got to remember that some of that cash might be tied up for some potential obligations. And that's a big thing you need to understand. I say, I have tons of cash, the investor thinks. Well, what obligations do you have? What short options do you have that are outstanding that if you were assigned that could eat away at that cash? Very important you think about that, okay? Now, any questions you have? So trade number one we actually did was SPX. More of a neutral range-bound strategy. Trade number two that we did is an Amazon cash secured put. Now, as we show these examples, what I need you to understand is some of these examples, you might say, I trade stock, but I don't do options. Or I trade stocks and I don't like, for example, short puts. I like verticals. Now, remember, when you come to these educational classes, it's a buffet. You get to decide if you want to eat, if you want to eat some, if you not want, you just kind of want to, or maybe you just want to watch, whatever you want to do. It's just an example. Okay. Now, so we're going to see that filled, and we confirm it filled right there, and we could see the fills from this morning. Okay. Iron Condor filled and the Amazon. Now, I want to kind of go back to some other trades that we're going to keep an eye on. Apple today, not much of a drop, but we did talk about that yesterday as far as adjusting the stop. That stop is still visible on the shares of stock. Okay. Microsoft getting a little bit of a bounce here today. Now, if we looked at, let's say, Microsoft, and we compared Microsoft to many other stocks that we see, Microsoft is still one that really has both lines of the moving average green. Now, where's that volatility been going? Well, the volatility has been going up. So notice investors know when the earnings is. If they know when the earnings is, the anxiety of investors, the greater forecasted movement up or down becomes higher and higher, okay? Now, what we're going to do in this example is, well, if you did like a credit spread, do you not get to take advantage of the higher implied volatility? Well, you do, but you're just on both sides. The premium should be higher, but you got to remember, you're selling something, getting a higher credit with higher volatility, but you got to remember, if you buy a put below you, that put is going to be higher as well. So you're going to see a marginal higher premium. But you got to remember, you're on both sides. If you sell a cash secured put only and then implied volatility is bigger, you're really trying to just grab that higher premium. Okay. So on this example, what we're going to do is we're going to kind of try to do on this one. The third example is a short put vertical. Now, notice the Iron Condor is a neutral strategy. The cash secured put is a bullish strategy, neutral to bullish. If we said, let's say, a short put vertical on Microsoft, now I'm going to also go on Microsoft closer to expiration. Now, if you really look at how verticals work, especially short verticals, you don't really notice that time decay until you probably get to about 20 or so days less to expiration. That theta starts getting higher and higher. Now, if I went to this just real quick to show you the difference, if we looked at the 410s, the theta on the 410 for the November expiration is at 22. We look at the theta on the 410 with 17 days remaining, it's 28. We look at the ones with 10 days to expiration, it goes to 40. And if you actually look at the ones that are, let's say this Friday, you're going to see are only 13. So what you're now starting to realize is, geez, when you start to get inside 10 days to expiration, good and bad, that theta is just massive, okay? 28, and it's going to go down to 22. Now, in our example, the strike that we're going to sell is where the investor thinks the stock could stay above. Thinks. Forecast. Forecast, check it up in the Webster's dictionary, does not mean actual, okay? Now, if we take a look at this, if we said, James, I think, the investor says, 415. Well, let's go look at the 415. And if we decide that we're going to sell the 415, let's close those up so we can make sure we're on the right one. Sell the 415 and buy the strike below, okay? Now, you might be thinking, James, put that delta back on so I could see that. Let's follow that. What delta does that have? 33. What type of open interest does it have? 5,400. So if we sell the 415 and buy the 410, right click, sell vertical, you're now going to see that if we did this, need to change that to the 405, credit there 275. Looks a little bit better than usual. It's because we're on the wrong short strike. No, we're not. It's because we have the wrong long strike. And if we look at that, now that looks a little normal, okay? More normal. Now, if we kind of said, okay, the maximum gain given this, 150. Given a vertical. Maximum loss, 350. The ROR, okay, 42%. So when you have a little bit higher implied volatility, those percentages tend to be a little higher, okay? So note that. That doesn't mean it's better. That just means that it's forecasted to be more volatility. Volatility is up and down. Now notice the commission. Now we also got to be thinking to ourselves, well, how much are we willing to risk? Now example given, let's mix this up. Let's say the investor says, James, I'm willing to risk $1,500. Well, $1,500 would give us about 4 contracts, okay? Confirm and send. Now, if the market were going to be more choppy, up, down, up, down, up, down, this position doesn't really, it's not super directional like buying shares of stock. The biggest thing about this trade is slight direction, time decay, and the third thing is really, when you take a look, is it's also trying to get that volatility to go down, okay? And you can know that if you brought that up, right-click, analyze the trade, and we only select, if we look at this trade and said, okay, what deltas do we have given the 4 contracts? Delta 20, theta 5, Vega is negative. Vega is negative because you're selling a strike closer to the current stock price. So whenever you have Vega negative, you want the volatility to go down. What might make the investor think that? Well, if you can get through earnings, that volatility tends to decline, okay? So that's the idea. Not as much direction, some, but it's really more about theta and time, that theta and volatility contraction, okay? We're going to confirm and send on this last trade. Note the max gain and max loss given the vertical. Note the commission. If that's okay, send the order. Now, let me kind of just say this in closing. When you look at the current market, kind of more of a pause, right? Keep an eye on the yen, which we talked about. Trade number 1 we did was the SPX Iron Condor. Trade 2 was the Amazon, okay? The cash secured put. Trade 3 we did is a short put vertical. Notice that those strategies are not super bullish. They're kind of more time focused. I think as the market changes, I think it's important that as the investor, you acknowledge that, and you might consider strategy adjustment or changing strategies based upon what you think might happen, okay? Now, I'm out of my time here today. Barbara Armstrong will be coming up next, okay? We'll talk about these trades over time to see how they're doing, just as we always do, okay? Now, remember with what we discussed here today, it was done for example illustrative purposes only. You can subscribe to the Trader Talks channel. Connie will put that link in the chat. That way you can subscribe for free, get all of our content and the playlist, okay, for each one of our classes. So stay tuned for Barbara coming up next. Thank you, Connie, and thanks to all of you as well. Now, remember with what we talked about, it was done for example illustrative purposes only. When we also, for example, bring up investing, you should always be looking at the risk or consider the risk first before thinking about the potential gain. Do you understand the strategy? And if you say, I'm not really there yet, that's why we have the Paper Money account, so you can practice the strategy and then ask yourself, is that really a strategy that you might consider? This has been the class called Investor Master Series. Thank you so much, and stay tuned for Barbara coming up next. Take care. Bye-bye.